Well, stocks continued to advance last week as calmer tones prevailed across the board, with the dollar continuing to pare recent losses and treasury yields continuing to tick marginally higher, particularly at the long end of the curve. Labor Day weekend now heralds the end of the summer for market participants as September kicks off with a busy week of risk events for markets to navigate, including several key economic releases, with the docket, of course, highlighted by Friday's US labour market report. Plenty for myself and Ryan Littlestone, of course, to discuss on the show. Without further ado, let's get into things. Well, of course, Labor Day will have been and gone by the time you watch this, and it's full steam ahead into the remainder of the year. And Ryan Littlestone from Forex Flow Live and Forex Analytics joins me, as always, to make sense of everything that's going on. And Ryan, it certainly feels like the end of summer here in London, looking out the window at a very grey and wet skyline this afternoon.
Very much so indeed. And yeah, raining here too down in sunny Bournemouth, or unsunny Bournemouth. And yeah, I've got 4 days left before the kids go back to school. So my summer's getting dragged out by the skin of its teeth. But markets are going to be full on this week. Lots of data, central banks galore. So looking forward to it.
Indeed, and of course that's only the start of what's to come, because we've got many more central banks meeting this month, including of course the Fed on the 18th, and then looking even further ahead than that, and I'm sure you'll love me for bringing this up, we're only 2 months away from Election Day in the United States as well, aren't we?
The amount of months you've caned me for bringing up the election, now we can't shut you up about it.
I know. Every week from now until then, I might even get Kyriakos to put a little countdown clock in the corner somewhere, like they do on transfer deadline day. Right, we can get that arranged. But in the meantime, we've got plenty to get into this week, including, of course, the non-farm payrolls number on Friday. So let's get into Topical Thunder. And that is exactly where I want to begin, because Friday is, of course, Jobs Day in the United States. The first Friday of the month means we get our latest read on the health of the US labour market. And of course, the August employment report comes after the softer than expected data in July, which was one of a couple of factors that led to that broad-based risk aversion at the start of August, and that significant dovish Fed repricing and everyone going over the top, including people calling for emergency intra-meeting rate cuts and all that other nonsense. Of course, the market pricing is in a much, much better place at this moment in time, with the curve pricing around about 31 basis points of cuts for the September Fed decision, implying about a 1 in 4 chance of a 50 basis point move, while also pricing just shy of 100 basis points worth of cuts by the end of the year. In terms of market expectations for the jobs report this time around, headline payrolls expected to have risen by 165,000 in the month of August, compared to the 114,000 that we saw in July, although of course that figure is pending any revisions that we get on Friday. Unemployment, meanwhile, that's seen falling to 4.2 from a prior 4.3%. The latter, of course, in July being the highest level since November of 2021, while participation should remain just off cycle highs at 62.7%. And average hourly earnings are likely to be, as near as makes no difference, unchanged at 0.3% on a monthly basis. Personally, I would argue, and Ryan, you'll have to wait as usual until midday on Friday to get my official non-farm payrolls guess, but I would argue that the risks are to the upside of those forecasts, given that we did have just shy of 250,000 temporary layoffs in the month of July as a result of Hurricane Beryl making landfall during the survey week. And you would expect that most of those temporary layoffs are to be reversed when we get the August labour market report, particularly considering that other job indicators, such as the initial and continuing jobless claims numbers, they haven't really signalled the same amount of labour market fragility as the employment report did last time around. That said, even if we were to get a soft labour market report, of course, the market would then move to price in a 50 basis point cut at the September FOMC, given Chair Powell's recent rhetoric around not seeking or welcoming any further weakness in the jobs market. But I think it's more a case of, as we've discussed at length, pretty much since we started doing this show, the labour market is merely normalising in a relatively steady fashion at this moment in time. The three and 6-month averages of payrolls gains are not too dissimilar to where they were towards the tail end of 2018 and during 2019, at the tail end of the last economic cycle. And I think the market is still rather too ambitious on the pace of cuts that we're currently pricing in.
I think you're right with that. And this jobs report is I can see it being a complete and utter mess purely on that headline number, because we've got, like you say, we've had the market saying that the BLS overstates numbers with that 818 revision previously. Then we had Goldman Sachs coming out saying that should only be a 300,000 revision because of immigrant workforce and everything. Then we've got the storm situation, 240, 250 people should come back into the market. So this number, it's already a lottery. It's even more of a wet finger in the air number. And that's going to create lots of volatility. I think if you want to take the sensible approach and in how to trade it and judge it really for what it means, is look at that unemployment rate and the participation rate. Stick with those metrics, because I think the main number is going to be a wild horse. So if we do see the 4.2%, that's going to, as you say, get the market thinking, the jobs market isn't in a really bad place. And even if we get a small number on the headline, that unemployment at 4.2% is going to show that things aren't too bad as well. Take into account that participation rate. It's very important in how that unemployment rate moves, whether it's higher or lower, based on that participation rate. Now, of course, the outlier will be if we do get a low number, and that's with the expected 250 jobs to come in from the storm and whatever else that's going on, the market could get a little hairy and particularly hit the dollar really hard, because it will be seen as a double whammy if we get a soft number. But as I say, just to repeat, I think looking at that headline unemployment rate is going to be the way to look at this number. Look through the noise, if you like, and get a true reading of what's going on.
Yes, indeed. And I think the key overarching question as we move through the August jobs report is, was July a blip, as we currently think it was with all of the weather that was going on, or was that more of a start of a trend of softening that we may see continue through into the autumn and the winter? And of course, one jobs report will not answer all of those questions, but it will help to give a little bit more evidence to one side of that debate or the other. But Ryan, it's not only the jobs report that we get this week, it's a busy economic docket besides that as well, isn't it?
Yeah, lots of data out this week. We've already had the start of the manufacturing PMIs from Europe and around the globe, and by the time you've seen this, they've all been out. Not been too much bad news this month going around. There's a little bit of softness. A lot of countries still in contraction, but there were some improvements, particularly from Europe. We're seeing things less rubbish, shall we say, including in the UK, which stayed unchanged as well. On Tuesday, because it's US holiday today, we get the ISM manufacturing, which is also expected to improve by around 0.7 of a point to 47.5. Watch the unemployment number or the employment number on this one, because it took a near 6-point dive to 43.4 from 49 last month. That was, again, another number that got the market wobbling after that NFP report. Wednesday is Services Day around the planet, and we also get some more jobs data, US JOLTS, and the Bank of Canada is also popping up. They're expected to cut rates by 25 pips. There will be a press conference for this meeting, and really for that one, I'm going to be seeing whether it's going to be a cut and done from the Bank of Canada and Macklin. Are they going to pause after they've cut rates already? On Thursday, we get some wage data from Japan, so keep an eye on that for the BOJ, and particularly if you're trading the yen. Income is expected to drop to 3%, a positive 3% from 4.5% price. A little bit of softening there in the wages numbers. In the US, more jobs data. We get challenger layoffs, jobless claims, and final Q2 labour costs. And then it's the ISM services number. Now, all the ISM services numbers are currently in expansion, so any big negatives in the headline or any of the others, like jobs and prices, could hit the dollar hard, particularly with those rate expectations trading a lot. Friday, it's all going to be about the NFP, as we've spoken about. We also get Canadian jobs. So the NFP is obviously going to play into the FOMC, and the Canadian jobs will really put whatever the messages from the Bank of Canada on Wednesday to the test. So if they're really dovish and we get a really strong jobs number, you're going to see an alteration in rate expectations moving forward for that one. get through all that intact, and we can all have a nice lie-in on Saturday.
Bloody hell. Yeah, lots going on this week, isn't there? Plenty to digest. I think there's a few interesting bits and bobs in there. Of course, the various ISM surveys are going to be used as a leading indicator for where the jobs report might lie on Friday when that is released. The JOLTS report is going to be interesting as well. Of course, a little bit stale, given that it references July, but nonetheless, it will be interesting to see how that chimes with the message that was, of course, sent by the non-farm payrolls number and the unemployment rate in July, and whether that paints a similar picture of labour market softness. But I think besides all of that, the BOC is actually going to be worth perhaps a little bit more attention than we would usually pay it this week. They've obviously delivered a cut in June, a cut in July. They're set to deliver another cut in September. And beyond that, the market also prices another cut at the following two meetings in October and in December, which would be a pretty aggressive pace, certainly compared to that of their developed market peers. So it will be interesting, as you say, whether we do get any rhetoric along the lines of, we're now going to take a bit more of a wait and see approach. Now we're well on our way towards normalizing policy, not only because of the impact that could have on the Canadian dollar, of course, but also as to whether that's something of a blueprint that other central banks might look to follow in the months and quarters ahead.
Yeah, and we've had this conversation about Macklem saying that there is a limit to how far they'll want rate divergence with the Fed. So they've been happy with, as you say, 2 cuts already and a potential third. So they haven't indicated they're at their limit yet, but maybe a third cut and that will put them at their limit or close to their limit, or we'll get conversation on that. But I think, yeah, they are looking pretty aggressive at the moment. And one thing a lot of central banks will be worried about is cutting too fast and stoking the very thing that they were raising rates against in the first place.
Yes, absolutely. I think the last thing any policymaker is seeking at this sort of time is a sort of stop-start normalization process where you deliver 1, 2, 3 rate cuts and then have to stop or even have a reverse course and raise rates again. I mean, at that point, you've lost all credibility ultimately. In any case, let's move on, because as Ryan mentioned last week, summer is now pretty much at a close and we are moving into, well, what I would call the final stretch of 2024. The majority of institutional participants, December is a little bit of a nothing month, just kind of closing up positions and squaring up your books. So it's really now until Thanksgiving, I would say, that we've got in the remainder of 2024, which leaves us with 2.5 months of fun left in markets this year. I wanted to just briefly highlight a few themes that I think may await over that time period, though, of course, I will caveat that with saying the first 8 months of 2024 have brought us plenty of surprises. So there could be a few other black swans and potholes to navigate around besides these themes that we're going to mention. But I think the 4 that I would sort of boil it down to, the first is the continuation of policy normalization across developed market central banks. Of course, the Fed are going to begin normalizing policy at the September meeting. Other G10 central banks will continue to do so. And the question remains whether they live up to the quite aggressive, dovish expectations that markets have currently priced, or whether we see a slightly slower pace of normalization across G10. Of course, the geopolitical situation will also rumble on. Sadly, there doesn't look to be any sign of a resolution to either the situation in Ukraine or the ongoing tensions in the Middle East. But I think last week gave us a good example of how the market continues to really trade geopolitics with a buy the rumor, sell the fact bias. The start of last week, we had headlines that Libyan crude production was going to come to a halt, exports were going to come to an end. Crude rallied $3 or $4 on the back of that. And then it came all the way back down again, with WTI ending the week about 3% lower. So very much a short-lived impact on many of those geopolitical trades at the moment. Here in the UK, of course, fiscal policy, I think, is going to be the main thing going into the autumn. We've got a budget due on the 30th of October, which, if you believe the political shenanigans at the moment, is going to be completely and utterly grim, with significant tax hikes and chunky spending cuts in the mix there. there. Whether or not that poses a headwind to growth remains to be seen. And of course, we have Ryan's favourite thing as well, with the election in the United States coming up on the 5th of November. The big event in the near term, at least, when it comes to that election, will be next Tuesday, the 10th of September, when former President Trump and Vice President Harris will face off in a TV debate. So plenty for market participants to digest. Already implied vols are ticking a little bit higher, and if you look at implied vol curves, you do have a bit of a kink around election day on the 5th of November, a big kick higher in volatility around polling day in the United States, and we will of course see whether realized volatility follows that higher as well. But I think everyone has had their summer break, and we're now back and ready and raring to go, and we've got plenty to get our teeth into through the autumn.
Yeah, and with the US off today, we're seeing pretty quiet markets. But as you say, if you look at the option vols, I keep an eye on the 1 month at the money vols. We've still got dollar yen trading up around 12, euro dollar up above 6%, cable up above 7%. So we're still, as you say, we've still got some elevated levels of volatility, and I think that's going to increase. Lots of events to come. It's going to be difficult to trade some of these events. You're going to have to jump in between certain times, certain aspects, just to find a trade, and all the while have in the back of your mind what's going on in the fundamentals and the bigger picture, which I'm going to talk about in a moment.
Well, I was going to say, what a brilliant segue that is. You say it's going to be difficult to trade around some of these events. You've now got a segment called Trade Planning. So I assume you're going to peer into your crystal ball and reveal all, are you?
Oh, I flogged the crystal ball years ago, and yeah. That was after a bad trade. I looked at the crystal ball, so I got rid of that. But no,
yes,
I use seaweed.
You had one
now
to sell.
Yeah, exactly. And I use seaweed now and wet finger in the air like everybody else. But no, this week, as mentioned, it's really going to be about trading the end game, which is what every central bank is expected to do at their next respective meetings. So I thought I'd put together sort of a little guide as to how to trade through this week. Now, the market knows the Fed is likely to cut in a couple of weeks, so all the data until then will add or subtract from those expectations. Bad data will cement cuts and even get the market pricing bigger cuts, as Michael mentioned. Good data won't likely change cut expectations vastly, but it may still squeeze some of the market doves intraday. What I'll be looking to do is trade any extremism in the data. If the market gets too dovish or too hawkish around data points, I'll look to maybe fade those moves, all the while keeping in the back of my mind that the Fed is likely to cut whatever happens. And knowing that end game, no matter what the data says, allows us to judge price moves and trade before the FOMC, and then understand where the market is at going into the FOMC, i.e., is it too hawkish or is it too dovish? That's where I think the opportunities will come from, be it for the Fed or any other central bank this month. Now, you'll maybe note that none of what I've said so far contains any I think language. This week is not about what we think. It's only about what the market thinks after each data point and how it prices what it means for the next central bank meeting. And that's exactly how we should look at it as traders too, and think about trading it. So I'm going to be rolling with the punches, I think, this week, but just keeping in mind what the end game is for these central banks.
Yes, I think you're absolutely right. I think that's a very good way to look at it. I would caveat that by saying some of us are paid to think, so I won't go too far down that potential rabbit hole. But it is always important to, particularly when you're taking a position or even a view or a bias on the market or a particular asset, it is what the central bank is likely to do, not what you think they should do, that you should be trading at any one time. Whether or not you think, the Fed funds rate should be 100, 200, 300 basis points higher than it is now, they're not going to hike again. Even Dickie Matthews has given up on his call for the Fed to hike again, which tells you how unlikely that is. So yes, certainly a question of the view on what is likely to happen rather than what you think should be happening is the key in all of this, really.
Yeah, absolutely. So don't think, do. I'm sure Yoda or someone said that.
Well, yeah, I mean, that go on. Not entirely sure what to make of that. So the safest strategy is to move on. Bloody Yoda impressions on the trade-off now. God, it's going to be a bloody long autumn, isn't it? Right, let's get on to safer ground with some charts. I want to look at the dollar index this week to kick things off. And you'll recall that I looked at the dollar index this time last week, and our eagle-eyed producer is not as eagle-eyed as I thought, because he didn't notice the very subtle change I made to the caption here, which is that the selling we saw in the dollar the week before last was indeed overdone, with the greenback having rebounded quite nicely from those year-to-date lows around the 100.5 level. As we said last week, it did seem like a little bit of an overreaction to what Powell had said at the Jackson Hole Symposium. Although I would note that it's interesting, we've seen the dollar pair some of its recent declines, and we've seen long end treasury yields rise by, I think the 10-year was up about 11 basis points last week. But the front end of the curve hasn't moved particularly much, and the OIS curve has barely budged, still pricing about 100 basis points of easing by the end of this year. So perhaps if we see policy expectations begin to readjust, that could give the dollar another leg higher. The growth side of the equation, that also continues to favour the greenback as well. We had a nice upward revision to second quarter GDP growth last week, now seen at 3% on an annualized quarter-on-quarter basis, which is comfortably quicker than that seen in any of the dollar's developed market peers. So I think there is plenty more left in the tank here, although of course the big risk is that we do get a soft jobs report on Friday, and that sees the dollar pair some of this recent retracement. But I do think, as we mentioned earlier, risks to the consensus for the payrolls number are probably tilted to the upside. So I favour staying long the dollar here and buying into any potential dips that we were to get.
I think, and you know my views on the Dixie and particularly the charts. I think that chart that you showed there is absolutely diamond for how you should trade markets. When you get big events, when you get big moves, you always ask the question, can it break a level? Can it break the big levels? And as you can see there, we pretty much matched that 160 level or 100.60 level. Had a little dip underneath it, but by and large it held. And when you get levels like that, it shows you whatever the news is coming, if we can't get through a level, that's a level worth trading, and we've got to bounce from that level, as you can see. I won't go into too much because that's one of my charts coming up in a shortly, but otherwise, yeah, natural reaction, you get a big move, it finally runs out of steam, and then you get a bounce. We're in a bit more of balance now, I should think, going into this week, all this data. Whether we test those lows again in the dollar, or whether we make another move higher and push right back up, take back some of those losses we've seen in August, remains to be seen. But that's the way to approach this, really. Watch these big levels. It's stopped there for a reason, and you've just got to know why.
Indeed, yes. And, well, we may as well move straight on, because you're looking at basically the dollar index turned upside down.
Yeah, the real trading market, other than that Dixie rubbish.
Hang on. You can trade futures on the dollar index. It is a real market. You can trade a cash product that we make here at Pepperstone based on the underlying front month future. It is a real market. It's not like the VIX where people, try and do technical analysis on that nonsense. If it was, then, you certainly wouldn't find it on one of my slides in this show.
I'm going to hold you to that. I'm sure we're going to get it one day.
No.
But as you say, mate, the euro dollar is really the Dixie in a nutshell. It's the biggest part of the basket. So what happens here really affects what happens in the DXY. And this was my play of the day last week. And the main reason for that was this big level up at 112. And that coincided with the 160 in the Dixie. This level really marked an area where we might actually break out of a near 2-year range. And I've been advising a lot these last couple of weeks that it's a good idea for people and traders to have two charts of their preferred pairs of assets. One for the everyday trading, where you might have a lot of technical indicators, and one to keep an overview of the bigger picture, something that's a bit clearer, doesn't have too much on the charts, just highlighting the really big levels. So we know the 105, 112 range, that's come through Fed hikes, the end of Fed hikes, all the ECB cuts, all the data, now the Fed finally turning towards cuts. For everything that's come through, we've held this range, and we did so again with that move in the dollar, getting euro dollar up to 112. So the range has been respected. The importance of that for our trading is that we now know it's going to take bigger news or really big news to break the range, be it some big news from the US, Europe, or wherever. Ranges like this are important for not just to trade against, but to manage expectations against. It's no good thinking that the Fed cut cycle will mean euro dollar is going to 120 if it can't even get through 112 before they've even started. For me, these wide picture charts will help me trade through all the data this week and into and over the Fed. If the levels remain intact or fail to break, or even fake break, that will tell me how the market wants to trade and therefore how I should trade. And the beauty of it is I don't need, again, to have an opinion. I don't need to, I think it's going here, I think it's going there. I can trade short against the 112 again, and if it tests and holds. If it breaks and then fails, I can try a short then. And I can also try longs if it breaks and holds. I need no bias to trade levels like this. I just follow the price action and react accordingly. So even if you are a short-term trader, looking at 15-minute or 1 hour charts, always know what the bigger picture is too, and look for these big levels, and particularly if they confluence with your shorter term levels.
Absolutely. You're on fire with all of the advice today, mate. You clearly had your Weetabix this morning, didn't you? I would fully agree with that. And I think most, certainly regular viewers of this program will know by now that I tend to look at almost solely longer term charts these days. There is a hell of a lot of intraday noise out there. And if you can discern, I should say, some sort of signal from a 1 or a 5 or a 10-minute chart, then fill your boots. But I think it does always help, certainly, to take a step back and just take a look at the bigger picture as well. Which, funnily enough, is exactly what I'm going to do now with the S&P 500, because we are back within about 60 points of a fresh record high in the S&P, the third straight weekly gain for the benchmark equity index last week, and we're again comfortably north of the 50-day moving average. That bout of volatility and selling that we saw at the start of August feels like a hell of a long time ago at this moment in time. And I think what's perhaps even more interesting is that the market continued and managed to eke out a weekly gain last week, despite Nvidia falling as much as 8% in reaction to the earnings that we had on Wednesday after the market closed. So everyone who was saying, the S&P is a bit of a one-trick pony, well, maybe it's not. I still think the path of least resistance leads us higher. It is worth noting that seasonality in September is typically negative, but you can't trade seasonality on its own, particularly if there is no obvious cause for that relationship to take place, I should say. And you're still in a situation where earnings growth is resilient and economic growth is impressive, as I mentioned a moment ago. One thing a few people have been talking about is, if we were to see a hawkish Fed repricing, is that a problem for the equity market? I feel like we had this discussion 4, 5, maybe 6 months ago. I would argue it's not. I think the key factor for equities when it comes to monetary policy all year has not been what is the Fed going to do, as in, are they going to cut at the next meeting? Are they going to cut 25? Are they going to cut 50? I think the key factor has been all year that if the Fed needs to cut, they can cut, and they've got 525 basis points worth of room to cut in whatever speed and whatever clips they want to, should they need to do so. And that is, in essence, the Fed put in action. And I think that should remain in place, whether or not they cut 25 or 50 in September. And as a result of that, dips should remain relatively shallow. Investors should still retain the confidence to stay a little bit further out on the risk curve, and new all-time highs are in sight.
I don't know what it would take to get the stock market going lower. We've come through financial crisis, which hit it, and then we saw record highs afterwards. We've come through banking crisis. We've come through pandemics, and the stock market does nothing but go up. I don't know what it takes for this to go down. So all I can do is really trade the levels. We've got these highs up here. If we break them, we're going to continue on, and up we go again. If we hit those high levels again, hold that level, then perhaps shorts are going to have a bit of a better time getting back in and seeing a bit more downside. And we might get a pullback down towards those recent lows, down in the 51s or something like that. But that Nvidia earnings last week, it beat on every aspect, and still the market wasn't happy and took the stock lower. So even when you get a stock that outperforms as it has done, it can't gain. That just shows you how crazy things are, and no doubt a couple of weeks' time it'll be back booming again.
Indeed, it certainly seems that way. But as you say, what is going to make the market go down? I don't think it will. But there are still plenty of bears out there who become very loud on social media as soon as we see 20 points worth of downside or something stupid. Anyway, moving on. You're in the equity space as well, I believe.
Yes, I am. I'm looking at the FTSE All-share, and a bit of a front running of the UK budget that Michael mentioned earlier. That's coming up in October, and while there's still some time away, that means there's time to plan for potentially trading it. There's really two components you need to look at with this budget. One side is the domestic side. For example, one of these budget policies or government policies is to scrap winter fuel payments for pensioners. Big uproar here in the UK, but it's not something that foreign investors care about too much. What they do care about is taxes or additional restrictions on making and even taking money out of the UK. And that's something for pound traders to note as well. It's really the foreign and investment side of things that's going to move the markets over this budget. Now, on the domestic front, the budget is also a trade-off between fiscal discipline and growth boosting measures. And with Labour continually moaning about the poor finances they've been left with, I fear the fiscal discipline side is going to outweigh potentially any growth initiatives they're going to bring up in the budget, which likely means we're going to see UK stocks sinking a bit. At the moment, the FTSE All-share index, which is more representative of UK stocks than the multinational FTSE 100, is sitting up near its all-time highs, much like a lot of the other indices. And I'm thinking about shorts running into the budget. Timing's going to be the key, though, I think. I think we have to get over all this data and maybe some of the central bank humps before I think about getting in. However, just mentioning, as you have with the S&P, I may be tempted to start small shorts if we hold those current highs through the data and some of the central banks. So, yeah, I'm looking for the short side of this. I don't see good news coming from this budget for investors.
No, I firmly agree. And I feel if I say any more, I'm going to get myself in trouble because we are supposed to have some semblance of political neutrality on the trade-off, even if the budget in October is going to be pretty painful. I think you're absolutely right. I think the big focus for institutional investors and international investors is going to be primarily on capital gains tax, given that seems to be the lever that the government are looking to pull. Why would you invest in the UK if you're going to have to pay a higher tax on those capital gains than you would in another jurisdiction? The other thing to bear in mind from a sector point of view is the potential for windfall taxes. Obviously, we saw those implemented on the energy sector during, not the pandemic, but during the early days of Russia's war in Ukraine, when energy prices went through the roof, and obviously profits of energy companies did as well. Is that potentially something government look to extend? Is that something they look to roll out to other sectors? That is obviously worth bearing in mind. And lastly, a sector play for the UK equity space is anything that the government may seek to nationalise. Think about things like railways. If they are nationalised, how does that work? How does that impact the various franchise holders, most of whom are listed in London as well? So plenty of plenty of moving parts, even if I could say it, and plenty of headlines, and none of them good is I think the summary of that. So on that incredibly optimistic note for UK PLC, let's have a look at our plays of the day. Right, well, I'm actually sticking with the UK this week, so I want to talk about the pound. And as Ryan's actually just made this argument very nicely for me, there is not much good news out there when it comes to the UK at the moment. And you look ahead to the next 3 months or so, and it doesn't look like there's going to be much good news in that time period either. Cable got a little bit of a reality check last week. We did trade up towards and just north of that 132 figure, and now we haven't come all the way back down, but we're starting to come all the way back down once more, trading below the July 2023 highs as this week gets underway. I think this downside move looks like it has the legs to continue, not only as a result of the negative catalysts here in the UK that we just mentioned, but also given that the dollar looks like it should be set to continue to rebound across the board. 130 is obviously the big level to watch to the downside. If we break below that, then you'd be looking really at that range that we traded in for much of the year before breaking out to the upside in mid-August, and that's between about 125 to the downside and 129 to the upside. But certainly at the moment, I prefer staying short sterling and selling into any cable rallies that we may get. Ryan, we're going to look at Brent, I believe.
Yeah, I'm going to look at Brent because you're far too pessimistic on the UK. It's bringing me out in hives at the moment. I think we're just about to collapse into a fiery abyss. So I'm going to look at something else.
If you read the FT.
Yeah, probably. Yeah, we've been in there about 8 years ago. So we're all burning alive as we sit here as we speak. Anyway, I'm going to look at Brent and iron supporting this one. These oil markets remain in a real roller coaster between the geopolitical strife and demand issues. And every time we get an uptick in conflicts, oil rallies. When that dissipates, the weak fundamentals remain and down we come again. With OPEC Plus mob, they're touting that they're likely to go ahead with their planned production increases in October, and a temporary lull in this Iran-Israel retaliation chatter. Oil is once again looking down. I'm going to be looking to see if we get a move down to the low 70s, around 71. There's been some strong support historically. It's purely a tech play, this one, off the well-defined support down there. If we get the US ISM manufacturing tomorrow and it's a stinky one, that could help this one on its way. So, yeah, I'm looking to buy support down in an old confirmed support area.
Good stuff. Yeah, OPEC's an interesting one. Obviously, those stories on Friday, you wonder to what extent that's a bit of a trial balloon to see how the market would react if they were to go ahead with those production increases, or whether that is, genuinely what they're thinking. Only time will tell. Of course, we are not far away from the start of October when they should kick in. In any case, that does bring us to the end of another show. Thank you very much, as always, to Ryan Littlestone from Forex Flow Live and Forex Analytics for joining me. Thank you also to our producer, Kyriakos, for bringing things together as brilliantly as he always does. Hopefully you've enjoyed the show. If you have, drop a like on the video, leave a comment as well. Let us know your thoughts and how you're trading and viewing the financial markets at the moment, as well as if there's anything you'd like us to discuss in the show next week. It is a busy week ahead, and we will be back with you this time next week to make sense of everything that's taken place, and also look forward to another busy week for the financial markets, because Ryan and mine, our favourite central bank, the ECB, they announce policy next Thursday, which gives us plenty more to get our teeth into. In the meantime, thanks once again for watching, and goodbye.